Coming up in today's show, stocks trade mixed as bond yields keep rising, the government averts a shutdown in the last minute, I take a look at the rising cost of money and what it means for markets, Tesla deliveries come in below expectations, and utility stocks continue to get whacked in their worst day in years. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. I hope you all had a great weekend. My name's Jared, and I'm going to get you all up to date on the latest market news, data, and charts out there. And today it was a bit of a tale of two markets. As you can see on the heat map, mega-cap tech really stood out today compared to the rest of the market, which was pretty bearish on the back of those rising rates, especially in utilities, which I'll get into a bit later on the charts. However, all of the Magnificent 7 mega-cap tech put in a strong day, even Tesla, even though they fell short on their delivery expectations a little bit. And so as you've probably already seen, the government was expected a shutdown on Sunday, but they got together in the last minute and hashed out a temporary deal and basically just kicking the can down the road another 6 weeks. But that doesn't have too much of an effect on markets, as in previous shutdowns the S&P 500 has held up pretty good anyway. And we've still got some bulls out there, like research out of Goldman Sachs, which is saying mega-cap stocks are at their cheapest valuation in 6 years, and they think their earnings season will outperform the typical S&P firm, and they're even going as far to say the sector is likely to keep outperforming the index through at least 2025. We've also got some similar sentiment coming out of Bank of America, saying investors should stay bullish on US large-cap stocks because the Fed just told us the economy is still too hot to stop hiking, and that's good news for stocks. They list 5 reasons why you should be bullish, including the S&P 500 is getting in good shape, high cash yields, power boomer spending, the Fed said the economy is still hot, and they're even saying stocks are a good deal even with high interest rates, and equal weighted stocks are still relatively cheap. And some are saying the S&P 500's next leg higher will rely on stocks outside the Magnificent 7. And it's those large mega cap stocks that's really pulled the indices forward this year. And if you look out across the market, which I'll get into on the charts in a bit, you'll see there's still quite a bit of bearish breadth out there. Not to mention corporate earnings are still in a recession on their third consecutive year-over-year decline. And that's because the Fed's aggressive interest rate hikes are eating into their profits. Most companies have debt on their balance sheet, and the cost of that is rising, especially when they have to refinance it. And the cost to raise new capital for new investments, expansions, and acquisitions is higher as well. So the bar for returns has been set a lot higher in this new environment, and that's not showing any signs of slowing down, with the 10-year Treasury yield finishing today at a 16-year high. And that's on the back of some comments we've been getting from Fed officials saying they're going to stay higher for longer. Some are even saying they need another hike or two. And so there's no signs that they'll be cutting anytime soon. And that's why we've got some research analysts saying something has to break on these rapidly rising bond yields, and that could unleash a financial accident, which is true when you look back in history. Most accidents happen after the Fed does raise rates really aggressively, and the setup is there for a big correction in the market. And you can see on this chart here, which shows the S&P 500 dividend yield minus the 2-year Treasury bond yield. And that's currently at negative 3.49. And what that means is you can get a full 3.49% higher yield in the safety of US 2-year Treasury bonds versus the dividend yield from the S&P 500. And just switching over to a 10-year chart, that's currently the lowest premium stocks have been versus Treasury bonds. And just going out to a 30-year chart, that's the lowest it's been since mid-2007 before the GFC unfolded. And previously before that was in the late 90s, early 2000s, which was at the start of a period where stocks would underperform for the next couple of years as well. And so even if the Fed does stop hiking, government bond yields and the cost of debt and yields can still keep rising. And a big driver of that is the government and their addiction to borrowing and spending at unsustainable levels. And if you remember back just a few months ago, they came up with the brilliant name, the Fiscal Responsibility Act, to raise the debt limit on government spending. And at that time, federal debt was at about $31.5 trillion. And since they come out with that nice sounding program, they've managed to add over $1.5 trillion to the debt, now passing $33 trillion, increasing at 5% in just a couple of months. And that's been an accelerating trend over the last couple of years, because we've seen roughly a 50% increase in federal spending between fiscal 2019 and fiscal 2021. And so you don't have to be a wizard to realize this is unsustainable, and it's very soon that interest repayments on federal debt will soon eclipse defense spending, which is already a huge portion of the bill, with America spending more on military and defense than every other country out there combined. And this is something millennials are going to have to deal with a lot over their lifetimes, most likely with much higher taxes and less social welfare and healthcare. And most politicians in Congress already well into their 70s and 80s will be long gone by the time the rest of us have to pay for it. And so with the government continually borrowing and spending money and big corporate debt refinancing walls approaching over the next year or two, Like I said, even if the Fed does stop hiking rates, that's keeping upward pressure on yields, which means downward pressure on bond prices. And we can see that in the daily chart of the popular bond ETF TLT, which holds long-term Treasury's just hitting a low today and just taking you out to a monthly chart. That's the lowest price we've been at since 2011, over 12 years ago. And I'd say this bottoming process in bond prices is going to be really ugly and messy and going for some time, months if not years. And it won't really be until the Fed starts cutting rates that we should get a really good rally in bond prices. And that could still be 2 years away. And the chances of a recession could be inching closer towards us, as we can see in the rapidly steepening of the yield curves that have been record uninverted for a while now. And there's just a look at the difference between the 10-year and 2-year government bond yields. And it's typically when the bond yields go from uninverted back to ininverted above zero that a recession's not too far away. And that's caused by short-term rates not rising as rapidly as long-term rates. So the market's kind of pricing in that the Fed is going to stay on hold here, as the Fed has really strong influence on short-dated yields, like the 1 year and 2 year. But if you just look at the price action in the 5 year, 10 year, and even more so in the 30 year, they're rising a lot more rapidly. And I'd say that's got more to do with a lot of long dated issuance from the government and them having to offer a higher yield to attract investor capital. Not helping the global economy is the World Bank, which just cut its growth forecast for China for the year 2024. And China, for the last couple of decades, which has enjoyed really high growth of 7 to 8%, has now been on a downtrend for a couple of years. And so they've now reduced their growth forecast from 4.8% to 4.4% for 2024. And they cited the persistent weakness of its property sector, which had been over-leveraged, overbuilt for many years, and that could still play out over the next couple of years. And on top of that is the West deleveraging from China and moving their factories out to other countries like India, Indonesia, and other countries like that. And I think things are a bit worse off inside of China than what they're letting on, because the worse the economy is, the more lottery tickets are sold. And we can see lottery ticket sales in China rose 53% in August from a year ago, and they've also got high youth unemployment, which is at 21.3%, a huge number. And just looking at a daily chart of the China 50 index, you can see it's right at its lows, and they're just struggling to put in a bottom for their economy and markets. Also out today was numbers from Tesla and their deliveries, and even though they came in a bit below expectations, their sales still grew 30% from a year ago, which makes it the fastest growing mega cap stock. They said they produced 430,000 vehicles during the third quarter and delivered 435,000. Production was up 17% from a year ago. Deliveries increased 26%, but that was a bit below what analysts were expecting at 461,000. And sales were likely hit by the longer than expected factory downtime in Shanghai and Austin as well, causing about 20,000 vehicles to shift into the fourth quarter. And we're still awaiting news for when the Cybertruck will come out. I and a few others were hoping we'd already hear about that by now. However, I think they're having a few delays there, so maybe we'll get something out of them by Christmas, and that should really get this stock and the market excited on that. And it looks like utility stocks might be reaching capitulation levels, falling a huge 4.7% today, which considering the normally low volatility in utility stocks is pretty much a crash for them. And that's on the back of rapidly rising yields, because utility stocks are considered defensive and most of the time are bought for their safety of their dividend yield. However, with them averaging about 3.5%, and now you can get well above 5% in short dated bonds, that's a big spread for yield-seeking investors. And just look at that chart of the utilities ETF XLU. Absolutely clobbed down here. However, I'd say we are technically oversold here. We're at minus 21 on my DSI indicator. We're firing off some reversal signals. And if we just zoom out over the long run, looking at all the instances, we've got this same technical setup with the DSI going this low, coinciding with reversal signals. We saw a similar setup back in October 2022 before we got a big bounce. Same deal in June 2022, and similar setup in October 21 and March 21 as well. And just to show you the correlation between utility stocks and government bond yields, here's an inverted chart of the utility sector. So basically just flipping it upside down. Then in the orange line here, I've overlaid the US 10-year yield, and you can see how the two assets move really closely in line with one another. So basically the higher yields go, the lower utility stocks go. So when you're buying utility stocks, you're kind of betting on interest rates as well. So even though I think we're oversold in the short term here in utilities, we're bound to get a bounce over the next couple of days and weeks. I wouldn't say this sector is going to break out into a bull market anytime soon, and that's due to really strong rising yields. We can see a similar setup in other interest rate sectors like REITs, real estate stocks getting hit pretty hard, and even consumer defensive stocks as well have been hit really hard these last couple of weeks, but are starting to look a bit technically oversold here. And since the news and everybody's talking about yields, we're probably due for a pullback in yields and a bit of a bounce back on the sectors that have been hit hard by them. Over to economic data today, we got a bunch of PMIs coming out. Manufacturing data across Europe coming in a bit above expectations, but still below 50, showing that manufacturing is contracting. And same with the States. Came in a little bit above expectations, but still a bit below 50. And just looking out to the rest of the week, we got JOLTS, job openings tomorrow, with some services PMIs on Wednesday, the usual jobless claims on Thursday, and the big one on Friday, non-farm payrolls. 170,000 new jobs expected to be created in the month of September. There's a look at how the Fed Fund futures market is pricing the Fed funds rate looking out into the future, saying there's 74% chance they're going to stay on hold when they meet at the start of November, and it's given slightly better 1 in 3 chance that they may do another hike in December or January. And you can see what's changed in the market over the last couple of weeks is they're now pricing in that higher for longer theory now. You can see it's not until July now that the market's pricing in a 1 in 3 chance that they'll start cutting then. A couple of weeks and a month ago, that was more earlier on next year that the market thought the Fed would be done. There's a fear and greed index still at the bottom of the fear zone at 28, and still not much interest from corporate insiders buying their stock here. Usually when the market dips, we'll see a bit of an increase in corporate insiders loading up. However, we haven't really seen that. They have pulled back on their sales, and just looking at Friday's data, we got a little bit of a bump up in sales. There's a look at my custom indicators, dark bull percentage on the S&P 500, sitting at a neutral zone at 52%, and we're still somewhat oversold on the S&P 500 oscillator coming in at 41 today. And just looking at the regular chart of the S&P 500, you can see it's kind of stalling down here, and that's typically what you see before a market makes a turn. It will stall out and consolidate, helping to create a bit of a divergence. So for now, we're still expecting a little bit of a short-term bounce in this market. However, it is on shaky ground. With these bond yields rising really rapidly, that's a strong headwind for stocks. But we actually saw the Nasdaq rally 0.83% today. It was back of an upgrade on Goldman Sachs on NVDA, and since the Magnificent 7 mega cap tech stocks make up almost a third of the S&P 500. That's what helped keep it flat today. But just looking across to the equal weight S&P 500, that actually broke down to multi-month lows. And like I said, there's a lot of bearish breadth out there in most of the market. We can see that in mid-caps, the Russell, and micro-caps breaking down again. Canada's TSX had a rough start to the month, finishing down almost 2%, right at the bottom of the support zone, and a bit of a pullback in the UK FTSE, and German DAX in a bit of a downtrend. Japan's Nikkei sitting out its support zone, and similar story in the Aussie 200. So all the international stock indices are looking a bit weak here. We've got volatility in the VIX starting to perk up a little bit. Seems to be holding ground above 17. And same with option dealers. Still demanding 5 points of premium over realized. Put call ratio is still hovering around 1. And breadth in the market just remains persistently weak. Only 10% of stocks above the 20-day average. 12% above the 50-day. And the amount of stocks above their long-term 200-day average continues to downtrend. And we just got multi-month highs in the amount of stocks making new lows. On the NYSE today, 162. Way higher than the amount of stocks making new highs at 11. And same deal on the Nasdaq, 175 new lows versus 13 new highs. But it's mega cap tech that's holding up that growth versus defensive sector spreads and the growth versus value spread as well. And there's small caps losing support versus large caps, and international stocks remain in a downtrend versus US stocks. And something interesting we got today was a bit of a breakdown in high yield bonds. There's a spread versus treasuries and inflation expectations. Broke out to a multi-month high. And there's a little look at foreign government bond yields. A 10-year UK holding there at 455, EU at 290 and in an uptrend, and Japan at 0.77 in an uptrend, and the China 10 years even ticked up a bit over the last couple of weeks. And there's that move in high yield government bonds. Getting sold off today pretty hard, down 1.1%, which is a big move for bonds and seems to have lost this support zone that we've been watching, but does have a little bit more support underneath it. And those strong bond yields are helping to keep a strong dollar index, and that's keeping some downward pressure on hard assets priced in dollars. Like cryptocurrency, we saw a bit of a reversal there today, and commodities seem to be finally succumbing to that higher dollar, with commodity complex at its 50-day. Gold getting sold off again, and we're looking for it to hold this support zone around $18.30 an ounce. And as we'd been expecting, a bit of a pullback in crude, and recent ripper uranium having a bit of a pullback. And over to stock sectors. Let's start by looking at my sector trends table indicator, and we can see there's a lot of red out there. It was energy, oil, and gas that had been real standouts and green, but they look to have gone into pullbacks now. And we've got quite a few sectors where it's red across the board. That means prices underneath all their moving averages. So the momentum and weight in the market at the moment is to the downside. There's a look at the cannabis ETF MSOS. Still waiting to hear some good news coming out of Congress about that Safer Banking Act. And there's the tech sector, which was the winning sector today. Clean energy came off hard, 4%, and quite a bit of red out there as well. Home builders coming off. Regional banks down 2.5%. Biotech still weak, down 3.2%. And of course, the losing sector, utilities, on huge volume, almost triple average daily volume traded today, and I'd say we're close to finding a short-term bottom and getting a bit of a bounce here. And there's Apple trying to reclaim that support zone we've been watching around 173, and all mega cap tech having a pretty good day here, really standing out from the rest of the market. market. Even Tesla, with those deliveries a lot below expectations, managed to hold up pretty good. But those recent IPOs, Instacart, still getting hit hard, down 9.2%, and British chipmaker ARM as well, a little bit soft. Looking across the meme stock space, was pretty weak down there, still getting hit pretty hard. There's GameStop finding new multi-month lows, and this is a stock I'm short in my Only Bears portfolio for my subscribers. It's been doing pretty well for us, and we're still holding this short. We'll be looking to cover this position in the single digits. Even one of the best performers this year in the space, Carvana, has lost its 50-day and seems to be in a short-term downtrend. Active today was 3M, down 3.6%. They've been having a bit of troubles lately with some litigation, lowering their growth expectations, and just looking at a monthly chart of this stock, it's been weak for quite some time. Now trading back to 2013 levels, and could be starting to get cheap here. Just looking at my stock fair value indicator, looks to be about 20% undervalued. However, I'm not ready to call a bottom on this one just yet. I think it still has some more downside to go, but I do have it on my watch list. One beaten down name I am a bit more confident on was one I mentioned on my video on Friday, Walgreens. The retail drugstore has been having a hard time for a long time now. We did get that really good pop-up on Friday, finished a little bit higher here today, and just taking you out to a monthly chart on this stock, this is one of the very few well-known, big brand, large cap stocks that's actually trading at levels not seen since a GFC low back in early 2009, a bit over 14 years ago, and I think in the low 20s it's setting up a good risk reward here, as my stock fair value indicator's got it 55% undervalued. And so in my mind, when I buy it in the low 20s, I think I've got about 10 points of risk in it, and I'll be looking for it to get back to fair value over the next couple of years, around $50 a share. So that to me is about a 3-to-1 risk reward, risking 10 points to make about 30 points on it. Also active today was Sphere Entertainment, formerly known as Madison Square Garden. They renamed themselves to Sphere Entertainment. That's the owner of the big Sphere in Las Vegas. They just unveiled their new concept with U2, went really well. Stock's up 11% today on a huge volume. And I can imagine their plans are to open those spheres in major cities all around the world. And based on future growth expectations, which my stock fair value indicator looks at, that stock could be undervalued as well by 32%. So this is one we'll be keeping an eye on, and I think has a great story, a unique product, and this could go a lot further. Other than that, wasn't too much of note else out today. Like I said, we got a bit of a pullback in the regional banks, and the big guys still soft here as well. Okay, getting back to the S&P 500 to wrap it up. You see the market's stolen here, trying to find some short-term support, which could still give way, and I imagine if it did give way, it could be pretty nasty, 3-4% down day. And just flicking on my market risk on off indicator, that was flashing red last week, letting you know the market might be going into a bit of a risk off mode. And going back in history, we can see when it's done that, it can indicate some upcoming weakness and that the market's on shaky ground. We saw that in the start of 2022 when it started flashing red. And before that, it had been a while before we had a few consecutive days. It had been in risk on mode most of the time since COVID. And it wasn't going back until COVID, that period. That was a really strong risk off period. You can see in late February 2020, it was really flashing red back then. And just flicking on my trend candles indicator, that's also going to bearish mode about a week and a half ago on the S&P 500, and same deal from the Nasdaq as well. After it had been in green pretty much the whole year, we've now got the indices, sectors, and moving averages all pointing down, so there's a bit of downward momentum in this market at the moment, and it looks to just be trying to find some short-term support here. But with that 10-year government bond yield ripping up really strong, this might go into a blow-off pattern, and that's going to be really bad for stocks, so we might actually lose that support. We'll just have to wait and see. But that's all for the first trading day of October. Thanks very much for tuning in to Click Capital, and I hope to see you again tomorrow afternoon. Cheers.